Hello and welcome to this Bloomberg Quint Facebook Live. Here on Bloomberg Quint, as with every other part of this economy, we are still trying to understand how the government's shocker move to take away 500 and 1000 rupee notes from the system is going to impact the economy. A status check first. It's been about a week and we know that the situation on the ground has not improved very dramatically. What we know is, of course, that there are still withdrawal limits at ATMs. 2500 rupees is what you can withdraw at one outing. There are withdrawal limits from banks, 24,000 rupees a week, and whatever old currency notes you take to the banks, you can withdraw only 4,500 immediately in reaction to those notes that are going into the system, which means the rest just goes into the banking system and you withdraw it at a later stage. What that tells you is that the currency flow is far from being back to normal. You also have very little indication or guidance of how quickly it will come back to being normal, which then raises the obvious question: what is going to be the economic impact of this? When 86% of your currency in value is withdrawn, there has to be an economic impact. The debate right now is it just short-term, a short-term blip which will show up in one quarterly GDP number, or is there a more long-lasting effect? We're trying to understand that over the course of the next 15 odd minutes. We'll be joined by two noted economists. We'll have Dr. Arvind Virmani, who's a former chief economic advisor to the government of India. We'll also have Pranab Sen, the former chief statistician of India, to try and understand and gauge the impact of this decision. We'll talk to Dr. Virmani first. And Dr. Virmani, thank you for joining us. I guess the first question is the short-term impact of demonetization, given that we've already seen a week's chaos in the market in terms of availability of currency. There is no going away from the short-term impact.
So the short-term effects are clearly negative, and by short-term I mean till the like you said, currency is used a lot for transactions. So leaving aside the store or wealth aspects of the cash, that is things saved in sacks and so on and under beds, if we take the transaction cost, transaction elements of the currency, clearly there will be a negative effect till that part of the currency is fully replaced. There it's a matter of judgment. I think the more dramatic effects, I had said right in the beginning, in fact the day after it was announced, there would be a fairly severe effect on retail trade and retail business activity in general, including, people have pointed out, day laborers, etc. All those, I call that retail activity for a week or two. After that, I think gradually, probably in the large metros, large cities, you'll probably get enough cash in there. But perhaps to reach the remotest areas, it may take a little longer, maybe 3 to 6 months. So, so the question is really of how quickly and how widely this currency is replaced in terms of its in the transactional system, where people have to deal.
Dr. Virmani, one sector through which one can gauge the impact of this process, both positive and negative, is perhaps the real estate sector. On the one side, there's a lot of talk that as black money, which formed a part of at least the high value real estate transactions, as that black money goes out, you could see property prices fall and become more affordable. So that could be one positive from a consumer standpoint. But on the other hand, if developers see increased stress, that could have a bearing on a number of sectors, from steel to cement to employment, given that real estate is a large employment generator as well. How do we gauge this real estate sector impact?
Right. So first of all, one has to be clear, which I have seen that many comments, particularly by technical economists, don't understand that if we genuinely are able to eliminate, the estimates are like 3.5 lakh crores of money, which is currency which is held in stock, so to say. If we are able to eliminate that much money, it's actually going to have a very positive effect on money, the black economy of real estate, actually. Because one simple way to think of it is that if 50%, let's say 60% of the transaction was paid in black money when you bought or sold real estate, if that money is no longer there, price could fall to eliminate that element. Now, obviously, that's a strong assumption. but people have talked about a price fall about 50%. So in that sense, the black element of that real estate is eliminated. So all you will be left with is transactions which are the part which used to be in white. So again, though I wasn't exaggerate the benefits, but I think these will be there, and most economists have kind of have not understood this. They keep asking, currency is only 5 to 10% of total black money, but if you are effective, then actually the real estate part, the black part really goes away. But as I have pointed out in things I have written, that you also have to take care of certain related things, like in Delhi and Bombay we have circle rates. You will have to reduce them, otherwise the prices cannot fall effectively, and things like that. If you take care of this issue, and with a little bit of luck, you actually could eliminate for a number of years, 3 to 5 years, let's say, a lot of the black money in the real estate sector also. So that's a collateral advantage. To your question of collateral damage, yes, what that means is, the flip side is that the recovery in the real estate and construction sector will be delayed. But here again, what I have suggested, I have written this formally, is that the compliance is going to increase this year. So the government is going to have a greater amount of tax revenues flowing from these actions, and it should plan to use them to spend more on infrastructure, particularly in infrastructure that goes into construction, so that a negative effect of a delay in that recovery is kind of countered.
All right, so real estate could play out both on the positive and the negative side. Dr. Virmani, one story we are already seeing playing out is the impact on interest rates in the markets and on the banking sector. Huge flood of deposits coming into banks, and all of that is sloshing around, flowing into the government securities markets. We've seen yields on the 10-year bond go below 6.50% today. We've seen 91-day T-bills at a cutoff of below 6%. So there is this sort of rush of money coming in, which could bring down interest rates. So while there's a currency crunch, there's a liquidity surge. How could that play out?
Deposits are being made into the banking system, and that has increased the liquidity. It's that same part, once it's in the banking system, it relates to my earlier point that people will now have to declare more income and subject it to tax. So that's actually part of the same thing, that they are being forced to deposit. They'll have to declare, at least for this current year, more income and pay more taxes. And as you said, the liquidity is an added benefit, yes. But remember, but just a caution here, some economists are confusing total money with the currency. The currency part still has to be taken care of. Just having more liquidity in the number one banking system, if I might say that for simplicity, does not help in the transactional part of it, because you still need that you've withdrawn a huge amount of money, 86% of the total currency. You still got to get at least 15 or so percent back in the hands of people, otherwise that part of the system will not function, the retail system.
One of the suggestions being put out there, Dr. Virmani, is that in this interim period where there is a currency shortage, one should give some sort of a credit boost to the economy. One way could be to open, say, a refinancing window for non-banking financial corporations who are on the ground, to encourage them to lend more, and look at other formal channels through which you can push credit. Do you think suggestions like that would actually help at this stage?
What we did was, in fact, it was suggested, I was at a discussion because I'm mentor to FICCI, I was a discussion there a few days ago, and one of the things we agreed to suggest to the government was that again, various aspects of the real estate, I've already mentioned one or two. Another aspect is housing. So things, policies, etc., to ease housing finance, to ease people, middle class or middle elements people to buy houses, etc., whether they were in process, etc., they should be accelerated, and perhaps if possible new things added along the lines what you are suggesting also. That's exactly it. So this is the time to make sure that this recovery at least is not delayed by taking these actions. Quite right.
One last question to you, Dr. Virmani, and that is on actually a theoretical argument that's been playing out between economists as to whether this has a bearing on the Reserve Bank of India's balance sheet. And if it does, is the RBI in a position to transfer an extraordinarily large dividend to the government, which would help its own finances? Do you see any merit to that debate? Where do you stand on it? Does the RBI have that capability? Can they do it? Will they do it?
As far as the RBI's balance sheet is concerned, I think people don't understand the modern monetary system. You know, the immediate effect is the cost of withdrawing money, the cost of printing new money, putting it out, etc. So that issue is all negative in a sense. Now, the part which is a little uncertain, which is the part I told you, that let's take the estimate I said 3.5 lakh crore. If that amount of money in a sense doesn't come back, that's a gain in terms of black money, but that money will disappear. The RBI will have to think very carefully about how much to really inject for transactional purposes. So there is no assumption in my mind that somehow they are going to inject a lot of cash into the system, because then you are bringing back the same old problem. If there is a lot of cash in the system, you are actually facilitating the recreation of black money. I can't see any reason why the RBI would do that. So net the extra cost of printing and withdrawing money is a cost. I don't see any big benefits from it which will increase its profitability.
All right, Dr. Virmani, thank you so much for joining us on that note. Just to sum up that one particular conversation and the views coming in from Dr. Virmani, a short-term impact to transaction-based sectors is inevitable. For a more medium-term impact, we need to watch what's happening in sectors like real estate in particular. Dr. Virmani also there saying that they, as part of an industry body, have suggested to the government, or perhaps will be suggesting to the government, that sectors like housing finance can be given a boost at this point in time to try and buffer up the economy a little bit. And then of course interest rates could act as some sort of a buffer, because the flush of liquidity has led to a decline in interest rates. It's tough to quantify something like this and the impact of something like this, but if anybody can do that quantification for us, it's Dr. Pranab Sen. He's the former chief statistician of the country, and he's joining us as well. Dr. Sen, thank you so much for joining us. I guess the first question to you, sir, is that how fleeting or not will be the immediate GDP impact of something like this?
Well, it depends. You see, basically what is happening is at the moment the efforts are to address the demand side, the retail side of the problem. And the hope is that the currency will trickle down backwards very quickly. I'm afraid that may not be true, in which case the pre-retail sale transactions are going to get impacted.
Can you help us put a number to it, or is it too difficult right now, Pranab, and on what is the kind of GDP impact that we could be looking at?
Well, one can make rough calculations, and I've done that, and it works out to roughly about 1% of GDP.
Dr. Sen, one sector that I want to focus on with you is the informal finance sector. Now, as we all know, and that's the reason we've been trying to push this whole financial inclusion drive, is that there is a large population of India which is excluded from the formal financial system. They depend on perhaps money lenders or other form of informal finance, a lot of which would be in cash. How does one try and judge the impact of that, and then the collateral damage that could be felt on consumers and also small businesses, sir?
Potentially serious dent, but the problem is we don't know how much, because what will happen is it will affect the stock of currency which is lying with these institutions. The money that's already been lent out is okay, that's in circulation, various other people will be converting it, but the money which is lying in stock is going to pose a problem, and we really have no estimate as to what proportion of the total 26% of GDP that amount is.
One last question to you, Dr. Sen, and this is on the agriculture sector. You know, after 2 bad monsoon years, we finally had a good monsoon year. We were expecting agricultural output to be far stronger. There are some anecdotal reports, and they're just anecdotal, that this could have a bearing on sowing from here on. It could have a bearing on the ability of farmers to purchase fertilizers, and that itself could have some impact on agricultural productivity. Should we pay heed to those sort of anecdotal reports? How would you see the agriculture sector impact?
Well, it will buffer it up to a point, but the thing is that the buck stops as soon as the personal relationship, that circuit, that network is violated. So moment you go outside that local network, that kind of trust IOU relationship becomes problematic.
Dr. Sen, thank you so much for that quick interaction. Those are 2 views coming in on the collateral economic impact of the government's demonetization move. Do go to bloombergquint.com. We've got a lot of views, we've got a lot of opinions, we've got a lot of news reports from the ground on how this demonetization story is playing out. Thanks so much for watching.